Forget everything you thought you understood about the housing rebound. As we step into 2025, the fractures are surfacing again, and this time, the damage spans entire states, not just isolated cities. From one end of the country to the other, property values are slipping in regions many assumed had already hit rock bottom. A surge in available listings, mortgage payments that ordinary buyers can no longer manage, and rising fear among investors are rewriting the narrative of the U.S. housing market right before our eyes. In this video, we're breaking down the top 10 states where prices are falling rapidly and confidence is evaporating even faster. Whether you already own a home, plan to buy one, or invest in real estate, this list matters because when full states start to decline, it signals a deeper shift. This isn't just a regional problem. It's a nationwide red flag that the so-called housing recovery might not be as solid as it appears. Stay with us through the final state on the list, and make sure to subscribe to Discover the Cities for data-driven analyses that reveal how America's housing landscape is really changing. Number 10. North Carolina. North Carolina's real estate surge was once one of the biggest relocation success stories in the country. Between 2020 and 2023, more than 300,000 newcomers made this state their home, drawn in by lower costs, warm weather, and the promise of steady growth. But as we move through 2025, that momentum has reversed. The same rapid expansion that once pushed prices higher is now dragging the market downward. Statewide inventory has exploded up nearly 70% compared to last year, marking the largest increase anywhere in the Southeast. In major metros like Charlotte, Raleigh, and Durham, the frenzy of bidding wars is gone. Homes now linger on the market for months, and median prices have slipped anywhere from 8% to 12%, depending on the region. Wake County and Mecklenburg County have seen the sharpest declines. Home builders, who just a few years ago couldn't construct houses fast enough, are suddenly scrambling to attract buyers. Incentives have returned in full force. $20,000 price cuts, free closing costs, even mortgage rate buydowns. In suburbs such as Apex, Mooresville, and Holly Springs, long rows of new but unsold homes stretch across entire neighborhoods. The massive construction push during the pandemic left the state with more supply than the market can absorb. Adding to the pressure, migration has slowed dramatically. Out-of-state buyers from New York, New Jersey, and California who once drove demand are no longer arriving in droves. In fact, some who moved in during 2021 and 2022 are already packing up again, discouraged by climbing property taxes, higher insurance rates, and instability in tech and finance jobs. Analysts warn that the core issue in North Carolina is structural. The state expanded its housing stock far faster than its wage growth, traffic capacity, or infrastructure. Even in former hotspots like Cary and Wake Forest, price cuts of $50,000 or more have become common. Appraisers are lowering their valuations, and lenders are tightening their standards with larger down payment requirements. Despite today's reset, North Carolina still offers an exceptional quality of life, strong universities, a diverse economy, and landscapes ranging from beaches to mountain ranges. Those strengths aren't going anywhere. But for now, its housing market is undergoing a much-needed correction. Number 9. Oregon. Oregon's housing story used to revolve around steady growth and natural beauty. People moved here for lifestyle and landscape, not quick profits. But by 2025, that old narrative has unraveled. What began as a subtle slowdown in 2024 has now evolved into a full statewide correction. Portland, once one of the country's hottest rising markets, has seen home prices tumble roughly 13% in the last year. In mid-sized cities such as Eugene, Bend, and Medford, values are slipping too, typically between 8% and 10%. Homes that used to find buyers within weeks are now sitting on the market for more than 60 days, almost twice as long as in 2023. For the first time since the pandemic, mortgage delinquencies are inching higher, especially in suburban areas loaded with homeowners who bought during the remote work surge. Many sellers are slashing asking prices by $50,000 or more in hopes of attracting attention. Even properties with solar upgrades, remodeled kitchens, and updated systems are remaining unsold for months. Population growth, once a key driver of Oregon's housing strength, has stalled. The flood of Californians that poured into the state for years has slowed sharply. High property taxes, soaring insurance tied to wildfire and flood exposure, and rising utility bills have pushed affordability to its breaking point. Investors who once snapped up rentals have backed away as profit margins shrink. Home builders are feeling the shift as well. New construction permits for single-family homes have fallen nearly 30% since 2023, a clear sign that developers are losing faith in near-term demand. Analysts describe Oregon's current phase as stagnation, less of a dramatic collapse and more of a long, grinding correction fueled by stagnant population numbers and stretched household budgets. Many remote workers who once powered Oregon's pandemic-era boom are now heading for cheaper states such as Idaho and Utah. Yet Oregon's natural wonders remain as compelling as ever: the slopes of Mount Hood, the deep blue of Crater Lake, and the rugged serenity of the coast continue to attract dreamers. But the housing data paints a different picture, one of a market cooling, resetting, and searching for its new equilibrium. Number 8. Minnesota. Minnesota's housing market used to be the picture of calm. For years, people viewed it as the steady middle path, far from the dramatic swings on the coasts and the unpredictable cycles in the south. But by 2025, even this traditionally stable Midwestern state is feeling the pressure. In the Twin Cities, the number of homes for sale has exploded, jumping more than 60% in just 12 months. Minneapolis and St. Paul have seen prices slip close to 10%, while smaller cities like Duluth, Rochester, and St. Cloud are experiencing double-digit drops for the first time in over 10 years. Neighborhoods that once enjoyed slow, dependable appreciation are now dealing with repeated price cuts and noticeably weaker demand. Several issues are fueling the downturn. Property taxes have climbed aggressively as cities try to deal with budget deficits. Insurance costs are also escalating, especially in water-adjacent communities that carry a higher flood risk. Meanwhile, wages have flattened, and everyday expenses continue to rise, squeezing families well beyond their comfort zones. In well-known suburbs such as Maple Grove, Eagan, and Woodbury, the shift is unmistakable. Homes that used to attract multiple offers within days now sit unsold month after month. Price drops between $50,000 and $75,000 have become routine rather than shocking. Builders are hitting the brakes on new developments, and banks are tightening their standards as sale prices drift downward. Beyond the economics, the emotional impact is significant. Many families who relocated from pricey coastal states in search of security are discovering that Minnesota's affordability isn't as guaranteed as they hoped. Winter heating bills, rising maintenance expenses, and increasing taxes are chipping away at the financial cushion that once made the state so appealing. Still, Minnesota's spirit hasn't changed. The lakes remain beautiful in the summer light, and the communities continue to embody the friendliness and resilience the state is known for. But the housing market, which once felt almost immune to national turbulence, now appears vulnerable. If you want a clear look at how America's most reliable markets are responding to the nationwide correction, be sure to follow Discover the CIDs. Because in 2025, the chill in Minnesota isn't just in the air, it's in the housing market as well. Number 7. Colorado. Colorado used to represent the ideal vision of starting fresh. People moved there for the crisp air, the dramatic mountain scenery, and the belief that property values would rise endlessly. But by 2025, that once unstoppable momentum has shifted sharply. What used to be one of the hottest real estate markets in the country is now cooling down far faster than anyone predicted. After nearly 10 years of explosive appreciation, the numbers have finally flipped. In major metros such as Denver, Boulder, and Colorado Springs, home prices have fallen anywhere from 12% to 16% in just a year. Out in the suburbs, Castle Rock, Parker, Longmont builders are scrambling to spark interest. They're offering steep incentives, rate buy-downs, thousands in closing credits, and even free landscaping packages. Even so, buyers aren't rushing in. At the heart of the issue is simple math. Housing costs climbed far beyond what local incomes could support. In Denver, the MQO's typical home now totals more than 7 times the average household earnings, making ownership increasingly unrealistic. With mortgage rates still elevated, even financially stable buyers are choosing to wait rather than stretch themselves thin. Insurance expenses are making the situation worse. The wildfire threat along the Front Range has expanded, causing premiums to skyrocket. Some homeowners who once paid under $2,000 a year are now facing bills exceeding $6,000. For many families, that single cost increase alone renders entire neighborhoods unaffordable. Analysts say Colorado's housing boom was fueled by a sense of invincibility. The surge of remote workers and out-of-state investors during the pandemic created demand that simply couldn't last. But now migration has slowed, and tech sector layoffs are unsettling the job market, leading to a steep drop in buyer activity. Even the high-end destinations, Aspen, Vail, and other luxury enclaves are feeling the strain. Sales of second homes have cooled dramatically, and short-term rental profits have dipped, leaving investors cautious. Real estate professionals describe the atmosphere as tense but not panicked, more like a collective pause as the market tries to find its footing. Yet the direction of the trend is impossible to ignore. Colorado is still stunning, with its towering mountains and dramatic skies, but natural beauty can't hold up a housing market that has drifted far beyond what residents can reasonably sustain. Number 6. Georgia. Georgia's real estate surge once seemed unstoppable. With rapid job creation, booming film studios, and non-stop corporate expansion, the state became one of the hottest property markets in the country. But by 2025, that powerful momentum has slowed sharply, exposing weaknesses that were easy to overlook during the frenzy of earlier years. Atlanta sits at the heart of the shift. Housing inventory has exploded up nearly 90% compared to last year. Prices in major counties like Fulton, Cobb, and DeKalb have fallen roughly 13% to 15%. A dramatic reversal from the competitive chaos of 2021. Suburban neighborhoods that were once flooded with bidding wars are now lined with "for sale" signs. In Marietta, Decatur, and surrounding areas, homes are sitting untouched for months, even after steep price cuts. Investor participation has almost disappeared. The large institutional firms that swept up thousands of properties during the pandemic have quietly stepped away, leaving behind excess supply. Developers, desperate to move their backlog, are offering just about every incentive imaginable: interest rate buydowns, appliance packages, even covering full HOA fees. Still, buyers remain cautious, and sales volumes continue to disappoint. Analysts say the root problem is simple. Housing costs grew much faster than household earnings. At this point, the average family in Georgia is spending more than 40% of their income on housing alone. Taxes are higher, insurance premiums have jumped, and utility bills have soared, pushing many first-time buyers completely out of the market. Even cities anchored by military bases such as Columbus and Warner Robins are cooling, with typical listings lingering for more than 2 months. Despite the real estate slowdown, Georgia's broader economy is still healthy. The film industry keeps expanding, and Atlanta's tech, logistics, and corporate sectors continue attracting new companies. But a strong job market can't fully compensate for a fatigued housing sector. A wave of new apartment construction has also redirected demand away from homeownership. Many potential buyers are opting to wait, anticipating another dip in prices before they return. The state isn't crashing, but it is cooling quickly. If mortgage rates stay where they are, economists expect another 5% to 10% decline in home values before the year ends. Georgia still shines with opportunity, yet its real estate sector is being reminded that no market can climb forever. For more insights into how America's once fastest-growing markets are drifting back down to earth, subscribe to Discover the Cities. Georgia's rise was impressive, but in 2025, its slowdown reveals the deeper truth of where the housing cycle is heading. Number 5. Washington. Washington state has long represented a rare balance, a place where untamed nature meets cutting-edge innovation, where mountain peaks tower behind bustling tech campuses. But even this Pacific Northwest giant isn't immune to the housing correction sweeping across the western United States. By 2025, signs of strain are visible from the coast to the Cascades. Seattle, which once ranked among the most competitive housing markets in the nation, has seen prices tumble more than 18% from their pandemic highs. Throughout the greater Puget Sound region, homes that used to spark bidding wars within hours now linger on the market for weeks. In cities like Bellevue and Redmond, price cuts of $50,000 or more have become routine. Farther south, in Tacoma and Olympia, buyer enthusiasm has cooled noticeably, with open houses drawing only a handful of visitors. Analysts say several forces are pushing the market downward at the same time. Elevated mortgage rates have pushed affordability to the breaking point, making homeownership unattainable for many. The wave of tech layoffs hitting companies like Microsoft, Amazon, and a broad swath of startups has further reduced demand and shaken consumer confidence. On top of that, the long-term shift toward remote work hollowed out parts of downtown Seattle, triggering ripple effects in both housing prices and rental markets. Investors are facing their own challenges. Rents have plateaued, while operating costs continue to rise. Property taxes are climbing steadily, and insurance rates have jumped, particularly in communities vulnerable to wildfires or coastal storms. As profits shrink, many small landlords are choosing to sell, adding more listings to an already crowded market. Even Washington's popular second home destinations are feeling the chill. Areas like Leavenworth, Whidbey Island, and the San Juan Islands have seen interest drop sharply. The combination of high interest rates and rising maintenance costs has caused vacation home demand to fall, even among buyers with strong incomes who typically fuel these markets. Economists describe the situation not as a dramatic collapse, but as a slow, intentional cooling. Prices are deflating, equity is slipping, and the mood among buyers and sellers has shifted noticeably from optimism to caution. Yet, Washington still possesses the natural magic that has always defined it. The evergreen forests continue to murmur in the wind, and the Seattle skyline remains breathtaking as it reflects across Elliott Bay. But behind those postcard images, a quiet and steady reset is unfolding, one that even the evergreen state cannot escape. Number 4. Nevada. Nevada has always lived in extremes. Few places understand explosive growth and sudden downturns as well as this state does. But in 2025, the familiar boom and bust cycle has returned with more force than many expected. The same region that once symbolized rapid expansion and quick profits is now facing one of the sharpest housing corrections in the country. In both Las Vegas and Reno, home values have fallen anywhere from 15% to 20% compared to their pandemic peaks, among the steepest declines in the western United States. Entire subdivisions that sold out almost instantly just a couple of years ago now have streets lined with empty homes and fading for sale signs baking in the desert heat. Builders throughout Clark County are pulling back on new projects, and they're offering huge incentives, rate buydowns, hefty rebates, even full closing cost packages. Still, contracts are falling apart as buyers step back. Nevada's once unstoppable short-term rental wave has also hit a wall. Airbnb and vacation homes have saturated the market, dropping occupancy rates to their lowest point in 5 years. Investors who used to earn effortless income from short-term visitors are now struggling to cover basic expenses like mortgages and upkeep. Many are choosing to sell often at a financial loss. Another crucial pressure point is water. With Lake Mead continuing to shrink and the Colorado River Basin hitting historic lows, state and local authorities have tightened development limits. Some regions have already restricted new building permits. At the same time, insurance companies wary of increasing wildfire danger and flood exposure have pushed premiums sharply higher, adding to the cost burden for homeowners. The wave of new residents from California, which once provided Nevada with steady economic momentum, has slowed down drastically. The remote workers who helped fuel the pandemic boom aren't moving in at the same pace, and many of those who did relocate are quietly heading back out, discouraged by rising expenses and fewer employment opportunities. Housing analysts widely agree that Nevada's upswing was powered more by speculation than by long-term fundamentals. Too much investor money and too little sustainable planning created a fragile foundation, and the current correction is peeling back those layers, one property at a time. Yet, despite the downturn, Nevada remains visually and culturally magnetic. The desert mountains still glow under the sunset, and the energy of reinvention still pulses through Las Vegas and Reno. But behind the scenery, the reality is clear. The Silver State's housing market is going through a profound reset, and the numbers reveal a story that can't be ignored. Number 3. Florida. Just a short time ago, Florida's housing market looked unstoppable, a bright, booming example of what a real estate powerhouse could be. But by 2025, the shine that once made the Sunshine State irresistible is fading fast. The combination of soaring living costs, vanishing affordability, and growing environmental risk has triggered a major shift. The biggest blow has come from insurance, and it's hitting homeowners up and down the state. In coastal regions such as Tampa Bay, Cape Coral, and Fort Myers, people who once paid around $3,000 a year for coverage are now staring at premiums that exceed $12,000 annually. Several insurance companies have pulled out of Florida altogether, pushing a massive wave of residents into the state's last resort insurance plan, a system already overwhelmed and showing signs of strain. The slowdown isn't limited to single-family homes. In Miami and Fort Lauderdale, the luxury condo frenzy that defined the last decade is losing momentum. International buyers, long the financial backbone of South Florida real estate, are retreating as global interest rates rise and rental income shrinks. Meanwhile, in Orlando and Kissimmee, the short-term rental economy is stumbling. Many Airbnb owners are unloading properties after months of weak bookings. Listings have increased sharply, and the price cuts are spreading. Even historically strong markets like Naples and Sarasota aren't immune. Properties that once sparked intense bidding wars now sit unsold for 2 months or longer. Builders across the Panhandle are delaying or canceling developments, worried that demand is slipping just as construction costs continue to climb. For the first time since the Great Recession, smaller Florida towns are reporting noticeable price drops, a sign that the correction isn't isolated to big cities, but touching every corner of the state. Housing analysts point to the same core issue. Florida is facing a collision between climate reality and financial pressure. Rising seas, growing hurricane exposure, soaring insurance costs, and increasingly cautious lenders have created an environment where many families simply cannot afford to buy even if they want to. The math no longer adds up. And yet, Florida still possesses a beauty that feels eternal. The waves continue to shimmer in the evening light, and palm trees still sway beneath golden sunsets. But beneath that postcard-perfect exterior is a new sentiment, a kind of exhaustion, as if the dream of Florida living now comes with a price tag too heavy to bear. If you're interested in how climate risk and financial pressure are reshaping homeownership across America, subscribe to Discover the Cities. Because in Florida, the weather may eventually calm, but the economic floodwaters aren't going anywhere. Number 2. Arizona. Arizona used to represent the wide-open promise of the American West, a place where sunshine, cheap land, and affordable homes offered endless potential. But by 2025, that promise is cracking. The state that once pushed the housing boom forward is now one of the clearest examples of a market sliding backward. The sharpest slowdown is unfolding in Phoenix, Mesa, and Scottsdale, where home values have fallen anywhere from 14% to nearly 20% compared to their peak. In dozens of brand new communities, construction has stalled completely. Neighborhoods that once had waiting lists now look abandoned mid-project, with half-built homes, empty cul-de-sacs, and weathered signs from builders who assumed demand would never run out. Analysts point to a predictable but painful source of the problem: massive overbuilding. During the pandemic boom, developers moved at breakneck speed, stretching deeper into Maricopa County and the surrounding areas. They believed the migration rush from California and the Midwest would continue indefinitely. Then, interest rates spiked, inflation squeezed family budgets, and demand collapsed almost instantly. Sellers have responded with deep price cuts. Builders are throwing every incentive on the table: rate buydowns, upgraded appliances, landscaping credits, but buyers remain hesitant, waiting for prices to find a true bottom. At the same time, Arizona's long-standing water concerns have resurfaced with new urgency. Tighter rules on groundwater usage across central Arizona are slowing down permit approvals. Insurance companies, alarmed by flood zone risk and worsening drought exposure, have raised premiums significantly. Rising electricity costs and soaring summer utility bills have made daily life far more expensive than it was just a few years ago. Investors, who once viewed Arizona as an undeniable profit machine, are backing out. Large investment groups are quietly selling off their single-family home portfolios, while short-term rental hosts are dealing with lower occupancy as tourism cools. The impact on everyday homeowners is severe. Thousands of residents who bought at the top of the market are now underwater on their mortgages. Some have decided to cut their losses and move on. Others are trying to ride out the decline, hoping the slide will slow before their equity disappears. Arizona's desert still holds its natural magic. The skies still glow red at sunset, and the landscape maintains its powerful, quiet beauty. But beneath that calm, the housing market is losing momentum, and losing it quickly. Number 1. California. California has long been the place where ambition meets opportunity, a state built on ocean views, big ideas, and the impossible made real. But by 2025, that powerful image is starting to fracture. What was once the gold standard of American living is now at the center of one of the most significant housing corrections the country has seen in decades. Across the state, the downturn is unmistakable. From San Francisco to San Diego, home values have slipped 12% to more than 22% since their peak. Properties in neighborhoods that used to ignite bidding wars now sit unsold for weeks or months. In the Bay Area, even traditionally bulletproof tech hubs are seeing price cuts. Los Angeles, Orange County, and the Inland Empire are filled with listings repeatedly shaved down in price as sellers try to keep up with a market that no longer moves on its own momentum. Experts point to one undeniable truth: California has simply become too expensive for the average household to survive, let alone thrive. The typical mortgage payment today is nearly double what it was in 2020, and home prices are still over 10 times the state's median income. Add in some of the highest property taxes in the country, and a homeowner's monthly costs can quickly spiral out of reach. Insurance has become another crisis entirely. As wildfire zones expand and flood risks increase, premiums have surged. Some insurance companies have stopped writing new policies altogether. Others have pulled out of the state entirely, leaving thousands of homeowners with only the state-backed insurance option, a plan that offers less coverage at a much higher price. The population shift reveals the rest of the picture. Californians are moving out in unprecedented numbers, heading east toward states like Texas, Nevada, Idaho, and Arizona. This migration drain is eroding demand and weakening the tax base. At the same time, layoffs in tech and a slowdown in entertainment have added another layer of uncertainty to an already fragile economy. Even California's biggest symbols of success aren't immune. Downtown San Francisco's towers still struggle with vacancies, and the ripple effect continues to push nearby condo prices down. High-end markets like Malibu, Newport Beach, and Santa Barbara, once known for quick luxury sales, are watching million-dollar homes linger with little interest. Further inland, in Sacramento and the Central Valley, updated flood zone maps have pushed insurance premiums sharply upward, making affordability even worse. And yet, California's natural beauty remains breathtaking. The Pacific Coast sunsets, the towering redwoods, the rolling golden hills. But the price to enjoy that beauty is now steeper than ever, and for many longtime residents, the dream has shifted. It's no longer about building a prosperous life, it's about managing to stay afloat. These 10 states reveal how widespread the housing decline has become, despite persistent hopes for a rebound. For buyers waiting for the perfect moment or sellers hoping for the market to snap back, the message is hard to ignore. This correction is still unfolding. If you want to stay informed as the market changes state by state and city by city, subscribe to Discover the Cities. We'll continue tracking every shift so you can protect yourself and plan wisely. Because in 2025, the housing market isn't easing back down, it's accelerating into a new phase of decline.